Datadog just exploded 31% overnight, but what really shocked Wall Street wasn't the rally itself, it's what this move might actually prove. The AI spending era is only getting started, and if Datadog's numbers are real, the AI sector could be heading into a second massive bull run. Hey everyone, on Deep Dive Stock Earnings. Here, we don't just look at price moves, we break down the logic and trends behind them. If you want to truly understand how the market works, make sure to like and subscribe. Let's get right into it. Datadog's earnings report basically reignited the entire AI sector overnight. After the report dropped, the stock surged 31% in after-hours trading, marking one of its biggest single-day moves in years. But what really got investors excited wasn't just short-term profits. It was the signal showing that AI demand is accelerating again. Quarterly revenue grew roughly 25% year over year. Large enterprise customers continued expanding, and AI-related business growth picked up significantly. Management even said more companies are now increasing spending on AI infrastructure. That means the AI slowdown many investors feared may not actually be happening at all. Instead, the AI capital spending cycle may just be entering its real expansion phase. And that tells us something really important. AI isn't cooling off. A lot of companies were only experimenting with AI before. Now they're starting to deploy serious money into it. And once enterprises move from testing into full-scale implementation, demand across the entire AI ecosystem could become much bigger than the market expected. A lot of people still don't fully understand why Datadog exploded like this, because it's not an AI chatbot company. Datadog makes money from the infrastructure layer behind AI. Every single AI-generated response requires GPU computing, cloud servers, system monitoring, and real-time data analytics. And those are exactly the services Datadog provides. As AI models become more complex, enterprise demand for system stability, cloud visibility, and data tracking keeps rising fast. In other words, as long as AI keeps expanding, Datadog becomes more valuable. Put simply, AI companies create the content. Datadog helps keep the entire system running. And as AI training scales higher and higher, Datadog keeps benefiting from the growth. That's why the market is starting to revalue it as a core AI infrastructure company. What really changed Wall Street's opinion was the forward outlook, because over the past few months, investors were starting to worry that enterprise AI spending was slowing down. A lot of people believed last year's aggressive AI spending boom couldn't continue. But Datadog not only beat earnings expectations, it also raised full-year revenue guidance. That tells investors management still sees strong demand ahead, especially from enterprise AI customers, where large contracts are continuing to grow. And that suggests AI demand may not be a short-term trend at all. It could be the beginning of a long-term capital spending cycle. Wall Street doesn't care most about how much a company makes today. What really drives stock prices is whether growth can continue for years. And Datadog's earnings basically told the market that AI spending may still be accelerating. This earnings report didn't just impact Datadog, it forced the entire market to rethink whether a second AI rally could be starting. Over the past few months, AI stocks have gone through a pretty major correction. Investors started worrying about stretch valuations and excessive hype, but Datadog's numbers reminded the market that AI demand is still extremely strong. After the report, multiple AI software, cloud, and data analytics stocks moved higher as well. Money started flowing back into the AI trade again. And now the big question for institutions is whether enterprise AI spending is entering another acceleration phase. A lot of institutions are already repositioning into AI software stocks again, because they're realizing AI demand may not have peaked yet. In fact, it may actually be entering a second wave of growth. And once Wall Street regains confidence, capital can move into this sector very aggressively. But at the same time, the risks are also becoming more obvious. AI fundamentals look incredibly strong right now. The problem is that valuations are already extremely high. Many AI stocks are no longer trading based on current profits. They're trading on extremely optimistic expectations for future growth. That means if growth slows down even slightly in future quarters, market sentiment could reverse very quickly, especially in a high-rate environment. Growth stock valuations become extremely sensitive. So the AI sector right now offers huge opportunity but also massive volatility. This market is extremely emotional right now. When stocks go up, everyone believes AI will change the world. But if earnings disappoint, money can leave just as fast. That's why managing risk matters more than blindly chasing hype. After Datadog's massive rally, market excitement started heating up fast. Retail investors are once again flooding back into AI discussions online. Social media engagement around AI stocks has surged again. And right now, Many investors aren't even afraid of losing money. They're afraid of missing the next AI breakout. Wall Street has a name for that, FOMO, fear of missing out. And historically, when markets enter a FOMO phase, volatility usually increases dramatically. But the most dangerous moments often happen when everyone starts getting excited at the same time. Because the hotter the market gets, the more violent the swings usually become. And that's the reality of AI stocks right now. They can't go up fast and they can't fall just as fast. If the AI arms race continues, the biggest winners over the next few years may not actually be AI app companies. They could be AI infrastructure companies instead. Because no matter who wins the AI race, everyone still needs GPUs, cloud computing, system monitoring, and data analytics. The more advanced AI models become, the more critical infrastructure becomes. And Datadog sits right in the middle of that ecosystem. It's essentially helping power the operational backbone of AI itself. That's why Wall Street is starting to assign higher valuations to AI software companies again. The logic on Wall Street is actually pretty simple. Whoever captures long-term AI spending could become the next major winner. And right now, Datadog is proving that it's already benefiting directly from AI expansion. What really matters here isn't just that Datadog jumped 31%, it's that the flow of money inside the AI market may be changing. Over the past year, investors were obsessed with AI chip companies, but now, more money is starting to rotate into AI infrastructure and AI software because Wall Street is beginning to realize that the long-term winners may not just be the chip makers. It could be the entire AI ecosystem, from cloud computing to system monitoring to enterprise AI deployment. All of these areas could continue benefiting for years, and Datadog is becoming an increasingly important piece of that ecosystem. And that's exactly why institutions are starting to seriously reevaluate AI software stocks, because they're realizing large-scale AI commercialization may still be in its early stages, and the companies that win long-term may not just be the AI applications themselves. Thanks for watching. If this helped you, make sure to like and subscribe. And feel free to share your thoughts in the comments. Do you think AI stocks still have more upside from here? And would you still buy Datadog after this rally? Let me know in the comments, and I'll see you in the next video.